This is the most interesting time in history to invest in commodities. And so I thought I'd ask the most interesting commodities investor I know to help explain why. Simon Popple, first of all, who are you? And secondly, why is my morning cup of coffee suddenly so expensive?
Hi, I write the Brookfield Capital Intelligence Report. I used to write Metals and Miners for Money Week and Gold Speculator with Jim Rickards for Agora. So I've been in the sort of commodity space for a number of years. And having been a director of one of the world's largest private companies several years ago, I was kind of out there looking for the next big thing. That happened to be a property company. I must say I got out of property a little bit too early, but I've been kind of expecting commodities to take off, and it looks like that could well be happening.
Yeah, there's been some real chaos. Before we started recording, you said that you've been enjoying the chaos while everyone else is not enjoying it so much. Explain to the viewers and the listeners why that's the case, how you personally have positioned yourself to benefit from basically carnage in commodity markets.
Well, I've been a contrarian, and even though commodity prices have moved up significantly over the last 12 months, I think compared to where they have been, I think there's still potentially a lot of upside for investors even joining now. And obviously there's a lot of things going on at the moment. We've got an energy crisis in the UK. We've got the pandemic. We've got concerns about inflation. But the thing I like about commodities, to be honest, is you can't print them. And I think in this day and age, anything you can't print that we use, and we use commodities in every aspect of our life, has to be something that you think about for your portfolio.
Let's look into that a little bit more, because the financial industry has become very sort of paper and tech and digital and theoretical and promises and IOUs and all of these things that are good in theory and might sort of appear in the future. Whereas what you focus on is very tangible things. And I think most people don't realize that there is an investment angle to those. And like you say, the backdrop of all of this fiat money printing and all of this interest rate manipulation and the COVID crisis, now is a good time to have the sort of reality of a tangible asset out there somewhere and to invest in the potential of that tangible asset instead of all of these promises.
Yeah, absolutely. I just think that, if my parents' generation, when they actually retired, they could get a decent annuity. Government bonds were yielding, I don't know what they were, 6-7%. But I think today you're an investor, if you like it or not. If you look at annuity rates, they're I think up 3.5%. Government bonds, you've got negative interest all over the place. And with the threat of inflation, you really do need to think about what you're doing. And I just think commodities are just a screaming area you've got to look at, considering, as you said, you can't print them and use them every day in your life. So why not have some in your portfolio?
Let's look into the size of this upside opportunity that you mentioned. There's some people that are concerned that the upside in commodities has already played out, but I want to show this chart, which hopefully will be appearing on everyone's screen now. It's the Goldman Sachs Commodity Index divided by the S&P 500. In other words, when the chart is high, you have the commodities that are very expensive and financial assets represented by the S&P 500 stock market index are very cheap, and vice versa. And right now, we're in a situation where commodities are extremely undervalued relative to the stock market, at least the US stock market. And that suggests that the size of this opportunity is very large. But I think that doesn't really capture what's going on in commodity markets, because there's a lot of chaos right now where individual commodities are booming and busting left, right, and center. I mentioned coffee at the beginning, iron ore, copper, uranium, and we'll get into some of these commodities. Why are so many booming and busting at various different times over the last few months?
Well, I think the bottom line is people need them. If you're developing your house, you need lumber, you need copper, probably, depending on what pipes you're using. And there's a lot of costs associated with them as well. You know, if you've got builders working on your house and you need copper piping, you need it like today. You can't just say, "Oh, I'm going to wait for the price to come down in a few months' time." And I think because of that, you end up with these rather extreme prices where people are paying, quite a lot more than market because they really need it. It's the same with house builders. With lumber prices, if you're building a house, you need the wood today. There's no point sort of waiting for 6 months until the price hopefully comes down. And so I think there's a real demand supply dynamic that's playing out at the moment. And we go into shipping in a minute, but I mean, there's so many kind of aspects and ingredients to the commodity market. I mean, because commodities are genuinely needed. If you need them today, you've got to have them today, and you're prepared to pay pretty much whatever price to get them.
The part of that I don't fully understand is, I mean, if the price of lumber goes up, it can't be that hard to suddenly increase the supply, or if the price of uranium goes up, or what's causing the price spike and therefore the investment opportunity for commodity investors?
Well, I think there's quite a few different dynamics in play here. I mean, obviously you've got, a tree takes a certain period of time to grow. You can't just print a tree. It does take time to grow. You've then got to cut it down, which isn't really an issue, but then you've got to transport it, and shipping costs have gone up dramatically. And then once you've got it to the other end, you've got, because of shipping and the demand for it, the prices are probably much higher. And if you've got less wood than the market needs, the only way you can correct that is by increasing the price. And I think that, unfortunately, people have, they've priced things assuming a natural supply, but now things are not working. There's panic buying as well, and panic buying, is human nature. People will end up behaving in a way that perhaps looking back on they view as irrational, but today it's perfectly rational behavior. So that they're prepared to pay more for it.
It seems like it's a self-reinforcing cycle where energy prices make commodities more expensive, and of course energies are commodities, and you get this repeat cycles effect that's playing out in all the different commodities. But over the last few weeks, we've seen that the gas price hit homeowners as well. Can you explain to people who are at home wondering what's going on, wondering if it's all about Brexit, why have gas prices and therefore their bills at home exploded?
Well, I think gas prices are they're fundamental to our daily life. I mean, they really are very important. I mean, that there's a variety of different catalysts for increasing them. Obviously, there's been supply constraints. Add that to other general we'll issues. Like the lack of lorries and trucks to actually move fuel around. And, we're going into winter. So, countries want to keep as much fuel back, both oil and gas, for their own domestic supply. And so if you end up with a sort of supply crunch, you naturally are going to kind of keep a lot of the commodity for yourselves, and then you export the surplus. But if you're worried about your own costs of producing the energy, oil, gas, you're likely to keep more back, and therefore you're going to be exporting less. Less supply, price goes up, and this is a sort of global phenomenon. And the sort of the natural supply of commodities is changing.
I was very familiar with the Australian gas market for a while, and my understanding was that if the gas price did increase dramatically, that there'd be a huge amount of supply that comes online that is producing at higher costs, and therefore any spike in gas prices would just be met with an increase in supply, particularly from the US, but also from Australia, and then possibly from Russia. Why hasn't that happened? What's going wrong at the moment that is causing the gas price spike to be unusually severe?
Well, there's a lead time to all these um, increases in supply, and you're absolutely right that I think if the price stays high for a certain period, then it means that more operations are economical, and therefore over time um, the supply should increase, and therefore the price should come down. But because it takes quite a long time, and it obviously depends on the plant, whether it's a new plant or it's a mothball plant or whatever the situation is. But it does take time for um, these to come back on stream. And I think you also need to think about the people providing the capital to uh, to to pay for them to come back on stream. Because if you're paying for the capital and you've got something where there's a cost of, let's say, 100 and the price is 120, but normally 80, then you probably want to see the price stay above 100 for a while to give you the confidence that you're going to get your money back. And unfortunately, that's where capitalism sort of comes into it. And because of that, uh, the pain can last much longer than perhaps it ought to.
There's a story today that the Dutch gas fields, they had closed some parts of them, and they might be coming back online because of all these problems. So it is starting to happen, it seems like to me. But let's move on to the Russian angle. There's always a Russian angle when it comes to commodities and energy markets. Nord Stream 2, the gas pipeline from Russia into Germany, has not yet been approved. And there's some talk about whether the gas is being withheld in order to force that approval. Do you think that could be behind the price spike?
Well, I think once it's approved, it's certainly going to help prices because it's going to help supply into Europe. So I think it is important that that the supply comes on stream. But I mean, I think it'd be interesting to see the extent to which it reduces prices, because energy firms. I mean, I'm sure you're familiar with the petrol pump. When oil prices go up, you tend to find that the price of your petrol goes up, but when the oil prices come down, the prices don't tend to come down by very much. So yes, I mean, I think you're right. I think we could end up with greater supply, and that should bring the wholesale price down. But the extent to which that impacts the retail price, we won't know until it happens.
I noticed you said when Nord Stream 2 is approved. Do you think it's a done deal then?
I don't think it's a done deal, but I hope it does go through, because I think Europe does need the energy.
I think that's the premise, is that they can force it through because Europe needs the energy. But let's move on to uranium, which is an area that I know you've had a huge amount of success recently. This is the big story in commodities right now. It might be the big story of the next 20 years or even beyond that. So why don't you sort of sum up what's going on in uranium with a bit of context as well, because that's what makes the story so interesting.
Yeah, well, my next door neighbor is probably the greenest person I've ever met in my life. And I was out walking the dog, and I got chatting to him, and I said, "What do you think the greenest form of energy is?" Expecting him to say solar or wind or something like that. And he said uranium, nuclear power. And I was just gobsmacked. This is someone who, his whole life is green. And so, largely because of that, I sort of went back and started looking at some uranium companies. And obviously the uranium price has moved significantly since really August. But I think that if you look at it now compared to where it has been, it's still pretty attractive. Yeah, I mean, a lot of us are familiar with Chernobyl and Fukushima and things like that, but nuclear power has moved on a lot since then, and the reactors are much safer than they used to be. The technology has improved dramatically, and so I think it's going to take a while for the public to sort of, I don't know, buy into nuclear power. But what I particularly like about nuclear power is, one, it's clean, and two, it gives you the base load. And the base load is so important because, if you're living in Texas, you would know that when they had the terrible storms, the solar and wind power got knocked out basically, and so you did need that base load. And the base load is going to basically come from coal, oil, or nuclear. And I think that the way the world is moving, I think that more and more is going to come from nuclear power, and therefore that has to be good for the uranium price.
Yeah, there was also news of a new nuclear plant that might be put in place in Wales and Anglesey, I think it was, that's looking for approval. So it's all starting to happen. But I want to turn to the shorter term price action in uranium, where something fascinating to me played out, which is the Sprott investment trust that launched. And it was a new style where it operated on an at-the-market basis. So can you take us through the mechanics of that? Because I can't explain it, but when I listened to someone explaining it, it was fascinating.
Yeah, look, I mean, I think the timing of the Sprott vehicle, I mean, I think it's only about 200 million compared to a market that is, well over $1 billion. But I mean, what they're doing is they're basically buying uranium, and obviously they can supply that to the market, but their whole premise is we buy low and we sell high. And but I think that their actions have not only have they done it for sort of commercial reasons, but it's drawn a lot of investor attention towards them, and people are going, well, that was the price then, now this is the price. And so even if you're interested in uranium outside the Sprott vehicle, I think more and more people are looking at uranium companies with a view to perhaps investing or having some sort of exposure to them, because the view is uranium has been cheap for a long time, and the price is going up. And I think Sprott has been a bit of a flagship in a way for sort of drawing attention to the market. But good luck to them. I think they've got their timing has been very, very good, and providing the uranium price holds up, which indications are that it should, they could do very well.
Some of the things that you've mentioned have led to an interesting conclusion. We've been talking about the time it takes to get these commodities and this power online, and the need for base load power, which leads me to the question, is coal the best way for an investor to play the green energy boom?
Well, that's controversial. I mean, I think that I think nuclear is the future, but we need to look at the present as well. And I think that I wouldn't say coal is a good way of playing the green market, because it's clearly not green. But I think that over the next couple of years, until more nuclear power stations come on stream, we still need baseload. And I think because of that, I think over the shorter term, I think that coal could do quite well, because the infrastructure is already in place for for coal power. But I think over the longer term, cleaner energy like uranium is it should do very well. And just moving on from that, I mean, if you look at electric vehicles, the world is going to need a lot of electricity to power these vehicles. And I think that the whole idea, the whole concept of EV cars is a cleaner energy. So it doesn't make much sense if you're producing the electricity with coal and then using an electric vehicle. I think ultimately that electricity is more likely to be supplied from nuclear power, and then you've kind of got the clean thread the whole way through.
Well, let's move on to precious metals then. What's your view? Because I've been writing about it so much in Gold Stock Fortunes, and so I've got all of my biases and all of my views. So I want to give you an open floor. What's your take on what's going on in precious metals? What have you noticed?
Well, the thing I love about precious metals is you can take them anywhere in the world. If you take gold anywhere in the world, it's still valuable. You can't do that with your house or with other commodities. It's okay taking a piece of wood, but try getting a piece of wood on a plane and then taking it to Canada where they've got loads of wood, and you say, do you want to buy my wood? And they go, well, no thanks, I've got a forest over there. Gold is very different. Gold, silver, platinum, palladium, precious metals, they've got global recognition. And I know people talk about Bitcoin and things like that, and there's a lovely quote. I think it was by Paulson, but he said Bitcoin is a limited supply of nothing. And but I love the fact that they're tangible. I'm a big fan of silver. I like gold as well, don't get me wrong, but I think silver, because it's got a use, whereas gold is more of a sort of I don't know, proven store of value, but silver has got uses as well. But yeah, I think they've got some very interesting days ahead of them.
What are some other commodities that you are on your radar that you're looking at the moment? Platinum, palladium, cobalt, nickel. There was a story about nickel in China today.
To be honest, everything you've mentioned, I like. I mean, I think you need a diversified portfolio. I mean, I'll give you an example. Cobalt, I think, is a really interesting commodity, but the Chinese have developed a battery that doesn't have any cobalt. Now, it's not as powerful as a battery with cobalt. Now, I think cobalt has got an amazing future, providing you can't develop a battery without cobalt. But if someone does do that, then that future's in trouble. I like graphite. Again, graphite is a very important component of a lithium-ion battery. But if for some reason you can create a battery without lithium or without graphite, those commodities could be in trouble. But I think that if you've got a diversified portfolio, if one commodity becomes slightly redundant, then you'll probably find that something else in your portfolio becomes very important. So, by having a decent spread of commodities, I think you improve the chances of finding something that's got a very bright future.
I'm assuming you don't have yellow cake in your cellar. How do you go about investing in these commodities?
Well, I actually like investing in the mining companies because they are looking or producing the physical commodity. And I tend to focus on companies. I use a fantasy football format to sort of describe them. So I've got a goalkeeper and defender that tend to be producing already. A midfielder is already perhaps new to production or about to start producing, and a forward's an out-and-out explorer. But so I like to have exposure to obviously different companies in different jurisdictions. I think there's an FX play there as well that is good, and in different commodities. So you've got quite a diverse exposure to your investment portfolio because you're investing in all these different companies all over the world. You've got different currencies, different commodities. I think it's quite an exciting thing to do.
Let's look into that foreign exchange, the exchange rate argument a bit more, because I've written a lot about it because I think it matters so much to our readers and viewers. In fact, I think it can be like a key part of investing, especially for Australian and UK audiences, which are the two that I write for. The currency moves can be absolutely massive and they can dominate your returns. So how do you adjust for that? What are the things you take into account, and which currencies are you interested in or not interested in?
Well, I think the thing you need to remember is, UK, I'm based in the UK. I've got a house, which is probably, I don't know, half the wealth, and it's in sterling and it's in UK property. And so I've actually got massive exposure to UK property and sterling through my own house. And so my other investments, I'm looking to diversify away from both real estate and sterling. And so I want to be in other commodities. Now, I don't want to be completely out of sterling because, you do want to have some exposure to sterling, but I think it's very important to have exposure to other commodities. And I particularly, given I'm a commodity guy, I like currencies that to an extent are backed by natural resources. So I particularly like, Australian dollar and Canadian dollar because they've got a lot of natural resources. Now, that's not to say that those commodities can't fluctuate. Of course they can, but I do feel like that there's more of an asset backing to them than perhaps some other currencies which don't have any kind of natural resource backing to them.
I want to explain a little bit more clearly why this matters so much. A lot of the people in Australia who invested in commodity stocks during the previous boom saw a huge chunk of those gains absorbed by the exchange rate. by which I mean that instead of the stocks going up a huge amount, also the currency went up a huge amount. If you're a UK investor who invests in Australian commodity producing companies, you get the benefit of both. You get the rising share price and the rising exchange rate, which increases your returns. So you're not focused on the US dollar then as a hedge to reduce the risk. For example, if there's some sort of crisis, commodities go down, but the US dollar goes up, which cancels out the losses.
Yeah, I mean, this is one thing I love about this market, because you could actually invest in a company on let's say the ASX, and the share price does nothing, but the FX moves, and so you make money. Likewise, the shares could, they could go down and the FX moves in your favor, and you can still make money. And so it's a really interesting market. And you're absolutely right. You need to look at both the foreign exchange rate and the commodity and the company. And what I tend to find is a producer, because they're actually producing the commodity, tends to move more in line. The share price tends to move more in line with the movements in the commodity price, underlying commodity price. Whereas an explorer, even if the commodity price goes down, if they find a lot more of whatever they're looking for, the price can explode. I told my subscribers about a company called Chalice last year, and that went from 15.5 cents to over $9. Now, clearly, that was a particularly fantastic story, but that's what can happen when you pick the right companies.
We can't do a commodities video without talking about China. What's your take on China's future for the next few years? Are they going to struggle financially and economically? Are they having some sort of bust, or are they going to have another round of stimulus and return to another economic and construction boom?
China is incredibly interesting. I mean, where do you start? I mean, looking at the electricity crisis at the moment, I've heard that basically what tends to happen is your larger factories tend to be told to use less power than smaller factories, but now it's actually hitting residential properties that are being they're having blackouts, and this is even causing problem with traffic lights and things like that. You've got certain cities where they've got chaos because they've had to turn the traffic lights off, and China, it has over 90% of the world's rare earths. I think it's got over 70% of graphite. I mean, there's a huge amount of natural resources within China. But it's going to be very interesting to see what happens. There's a lot of talk about the Lehman effect of property development and properties in China. So we really don't know, but I think the government will be helping them to a point. But to what point, I think that's the $1 million question, and unfortunately, we won't know until it happens. But they clearly want to make sure that things do go as well as they possibly can. But I think even that's going to involve a rough ride, but we're just not sure how rough that ride's going to be.
Let's return back home. Are we in for a winter of discontent?
It's difficult to see how we're not, if I'm honest. It's here in the UK, we've got a shortage of lorry drivers. That's fundamental. They need to transport food to supermarkets, fuel to petrol stations and things like that. Hopefully that will be dealt with. But again, you can't deal with it overnight. It's going to take a while to resolve. And I'm not sure how quickly they'll manage to resolve it, but I'd be surprised if they can do it in weeks. I think it's more likely to be months. And, where are we? We're sort of coming towards the end of September. And so even if they can resolve it within a few months, that's going to take us pretty heavily into the winter. So I think we've certainly got a few tough months ahead of us, and hopefully no more. But it's difficult to see how anything could be resolved really quickly.
Yeah, I'm getting worried about what a different type of lockdown would do to the UK, not just the economy, but just the national psyche. Unfortunately, we're going to end there on that miserable note. Simon, can you tell people if they're interested in all of this, if they're interested in commodities, where should they go? What's your website? And what should they do there? What should they sign up to?
Okay, great. Well, I mean, the website's, if you go to www.brookfieldcapital.com, I'm the author of the Brookfield Capital Intelligence Report. So I produce a weekly newsletter covering commodities that I like and companies I like. And, by all means, arrange a call or just get in contact somehow through the website, and, we can take it from there.
That was Simon Popple from Brookfield Capital. Thanks very much for joining us.